In this video lesson, I will explain to you what are the Forex trading basics, the terms that you need to know in order if you would like to trade on the Forex market. On the left side, I have an article written here on the Get No Trading website, which says Forex Trading Basics, where it is listed everything that is necessary to know at the start as a beginner. In trading, what is very important. On the right side, I have a trading account, which is a demo account, where I will show you these details, what I explain with the content on the article. So this way you can understand what I am saying directly on the chart with an example. I have used and put gold against US dollar. This is a 1 minute time frame, where you can see how the price behaves and creates the movement up, then down with the bearish candles, then bullish candles, and so on and so on. Then you can see here two lines which represents bid and ask price, which are necessary when you are opening an order. Below here you have a current account balance, which is very close to $10,000, and here it is a window where you will see all the orders that are open. Now take a look here. On the left side, we can see what we'll cover today. In this lesson, I would like to cover what is the Forex spread, what is the leverage, what is the margin, what is the bid and ask price, what is a pip, and what is a lot size. And then at the end, what is volatility. So these are the most important basics in trading if you would like to know how to trade. When you know them, these basics, you will understand how the market works, what is expected from you, and how to do any of the steps. Let's start. First of all, the first one is Forex spread. Forex spread in trading represents a fixed cost or fee that the broker charges you. It is a spread. This is a difference between the ask and bid price. You can see an example here on the image where it says that the spread is 7 pips. So when you open a trade, the broker gives you a cost of 7 pips if the spread is 7 pips. If it is a less spread, then you pay a little less than that. So it is there is a possibility for the broker to give you a trading option to trade with spread, which is the cost that you whenever you open a trade, or there is a commission that you pay also with a fixed fee. Most of the time you will see a broker that charges you a cost of a spread whenever you open the trade. So for example, on the right side where the chart is, I will open a new order so you understand what I mean. I will click here a button for the new order, and you can see there are two prices. First one is this one, 2374.91, and the second one is there. So you can see there is a price difference, slight difference, which represents a spread. On the right side, let me change this one. I will change the colors of these lines, only the gray one, so you can easily see. Just a minute. Ask line is orange red. Let's put it at the red. And where is this one? Oh, sorry, I'm not able to change the bid price, but it is a gray line. You can see the difference between these two prices, which is changing all the time, which means that spread, the cost, is not fixed on this broker which I'm currently using, and that is IC Markets. Some of the brokers have a fixed spread, which means there is always the same price difference between the bid and ask price, between these two price levels. So for example, let's click sell by market, and that means I'm expecting that the price will move down, so in order to make the money. So at the market price, I will click sell by market, and immediately when I open the trade, I will be in minus for some number of cents, because whenever I open the order, the broker takes a little cut, which is called a spread, which is a cost for each trade that you open. So if the price goes in my favor, that means the price goes down. This will make my trade, which is currently open here, to make money. So if the price goes against me, I will lose normally the money. But at the start, whenever I open new order, I will open a new one, so you can see that. Whenever I open a new order, buy or sell, for example, let's open now buy the market. You can see I'm immediately $0.1 in minus, and that is the spread, the cost I'm paying to the broker that allows me to trade on the market. Now, it is always the best to have the broker that has a small spread, which means it is a smaller cost. And if it is possible, it will be the best if it is fixed spread. So you do not need to pay each time on each trade a different price or different cost for the spread. Now let's move to the next one. What is the leverage? Leverage means borrowed money from the broker. It's virtual money that allows you to trade higher volumes on each trade. So in my case, what kind of leverage I have on this trading account, it is something that is defined when you open the trading account. In my case, I have a trading account here with IC markets, but whenever you open a new trade account, you select what is the leverage. So for example, let's open a new account. Let's try to open an account, just a minute. Okay, I'll open new account. Let's find some of them. New demo account. Let's check this one. And here inside this window, you can see you can select what is the leverage. Leverage can, in this case, for the demo account, can be 1 to 100, and the minimum one is 1 to 1. So, which one will you select depends on you. Most of the time, for starters, it is 1 against 100 is enough. But if you would like to have a better protection, it is the best to have the smallest one which is possible. If you would like to have at least one of the leverage, use 1 against 10. What this means, you can see inside the article. I have explained a little bit more details. What is the meaning and what the leverage means. Usually the leverage just means how much lot size can you open, which means how much risk is it allowed to have on a trading account. For example, on the $10,000, what could be the highest lot size, and I will explain that later on, how much money you can risk on your trade on your trading account. If the leverage is a small one, then you can risk less, and that means it is a better protection for you, so you cannot lose too much money on each trade. But what if just a minute, let me return next. What if the leverage is 1 against 100? That means that each trade can be opened with a higher lot size, which means each price change on the chart can give you more money, but also can give you a higher risk. So this means you can, if you start losing the money, you can easily lose a very high number of your money from your trading account. So it is very important to understand what is the leverage, and for that it is very important to read these articles I have written here, so you can have other articles I have written, what is leverage in Forex and what is the best leverage in Forex trading, so you can understand. I have created also a video with an example, so you can understand what is the difference between different leverages. So this will be much better to understand with the examples. But here I wanted to explain to you what leverage means. That is, just to repeat it one more time, higher leverage gives you higher opportunity to make more money on each trade, but gives you also a higher opportunity to lose more money. Lower leverage gives you less possibility to earn more money on each trade. You make less money, but if the price goes against you, that means you also lose less money. So for the starters, it is always the best to have a smaller leverage, which will limit your possibilities to open a trade that could wipe your account in one trade. So this is not the goal. The goal is to make money slowly, but also to protect your account. Next one, what is important is a margin. Now, the margin is something that it is defined by the broker. So here on the left side, you can see what is the margin required from the broker. Some of the brokers gives you a limitation, which means if the margin required is 0.5% of your trading account, then you can open a maximum leverage of 1 against 200. If the 2% is the margin, you will open maximally 1 against 50 leverage. So the margin is something that protects the broker and also the trading account. So here the broker uses the margin when you open a trade. The amount broker use as collateral depends on the trade size. When you increase your trade size, open more trades at the same time, the margin amount increases. I have written another article, what is margin in Forex and what is the free margin and what is the margin call. So for example, let's say open new order here. Click, for example, buy by the market. And here you can see there is values that tells you what is the margin amount, what is the free margin, and what is the margin level. The free margin here represents an amount of the money that this trade can lose. So for example, if my trade goes against me, I will have an option that I can lose 9,988 around dollars that I can lose spent on this trade without a broker asking me to close the trade. So when my trading account balance goes down, that means this equity which is changing, how this trade is changing, how the profit changes. When the equity reaches very close to 23.77, the broker will call me, will announce that there is a potential margin call, which means I have spent everything from the free margin and I should close this trade before the price goes all the way against me and deletes the complete equity and also my account balance. So this is the amount that you can see what you can have. This margin percentage is usually defined by this table, these percentages, but this is something that you check with your broker whenever you start trading. This is very important because if the margin is higher, it will protect your account much better, which means the margin call, which is a notification from the broker that you are losing too much money, will come very quickly before you lose all the money from your trading account. Remember, the goal is always to protect your trading account balance. Then we have a bid and ask price in Forex. A bid and ask price are the price levels that you can see on the chart, which are marked with the red and the gray line. If I go here on the upper side where I have shown you this spread topic, you can see that the ask price is the price above and the bid price is the one below. So red line here is the ask price. If I go right mouse click on the chart, go to properties, you can see that the ask line is colored in red. So this is the red color and this is the gray color. So the bid and ask price represents, just a minute to open this order. The bid and ask price represents what will be the price for the sell order, what will be for the buy market. If you click sell by market, the price at which the order will open will be the ask price. So for example, if I click sell by market, the price will open at 2377 point, for example, 86. The price has changed slightly because it's changed very fast, so it is very close to this one. I will try to open a new one again, sell by market. Here it is. Now you can see I have managed to open the sell order at the ask price. So the ask price is the red line. If you open a buy order, the buy order will open at a bid price, which is a gray line. If I click the buy market, you will see 2039. It has changed very quickly at the time when I click it. Let's try again. Buy by markets 56, 69, 72, 75, 80. It's very fast changing. So I'll try to sorry, I could not manage, but you understand what is the idea. The idea is that the price will open at the bid price for the buy order. So this is the only thing about the bid and ask price that is very important to know, because it is important that you understand when you click the open order at which price the order has been opened, if you take a look on the chart based on how the price changes. Now you can see the next topic will be what is a pip. Now the pip is very important thing to know, because the pip will be something that you will need to use to calculate how much money you will make on each trade or whenever you open this one. The pip is the smallest price change for the price. So each symbol if you click here on the market watch where all the symbols are, each symbol has its own pricing. So for example, this one, CHF SGD, has 1.51105. It has 5 decimal points behind the dot. Then for example, this one has 3 decimal points. This one has 2 decimal points. So you need to know how the broker defines what is the pip on each symbol. So for example, if we take a look here on the chart for the Euro USD, just a minute, black on white, okay, remove the grid, just a minute, I need to prepare the chart for you so I can understand easily. If I go to the Euro USD, you can see that it has 5 decimal points. So what is the pip? The pip is the smallest price change in the price. So if the price changes on the 50 decimal points from 0 to 1, you can see that how it's changed. This could be changed by 1 pip. But remember, the smallest price change is defined by the broker. If the pip is defined as the 4 decimal point or 50 decimal point, depends on the broker. If you go here to the Euro USD, click the right mouse button, click specification, and then you can see here the details about this symbol. If you go down, you can see also more details about this symbol, and inside should be information about what is the number of digits that this symbol has. So for example, in this case, this one, it has 5 digits. So this means it has 5 decimal points after the dot. How much will be 1 pip? It is defined by the broker, and this is something that you need to check with your broker. I will close these trades so I can also explain to you an example with a pip. Now, in this case, for the Euro USD, the pip is on the 4th decimal point. On the smallest one, which is the 5th decimal, on the 5th decimal point is the pipette. It is 1/10 of 1 pip. So if I click open new order and click sell by market, and I will change this one to volume to 1. I have changed the volume. I will explain that in the next topic. But here it is. For example, whenever the price change by one digital point on the 50 decimal point, you can see how the price changes here. How the price changed, and you can see that the current it is changed by 1, and it has been -6. You have seen, if I have seen correctly, it was, let's see, it was -3, so in -4, it is currently -$11. The pip is the change by the 40 decimal point. So whenever the price changes on the 40 decimal point, you also change the profit here on your trade. Here inside the article, you can understand here that there is a trading price at 1.208416, which has 5 decimal point. And you can see that the last 2 digits, which is 16, represents 1.6 pip and 6 pipettes. If you want to learn more about the pip, you can read also this article, which will show you more details about the pip and also how they are defined on the, for example, on the Japanese pair, which has 3 decimal points or 2 decimal points. This numbering for how many decimal points depends on the broker. Some of them have, for example, for the Euro USD, have 4 decimal points, some of them have 5. For the Japanese pair, some of them have 3 decimal points and some of them have 2 decimal points. Then in the next topic, the pip range. The pip range is very important also for your trading because it defines you what is the maximum price level and what was the minimum. So how many pips the price has changed during one candle time frame. In my case, I have a daily time frame. That means that this candle here represents 1 day. So in the morning when the market opens, the price starts from this open price, then moves up and down, and it has a minimum to maximum around 58 pips. You can see that it is 580 here written, but the last digit is a pipette. So I remove the last one, and then I have the number of pips for a pip range for that day. If I go to the next one, let's say for this one, if I go from the maximum to the minimum, I can see that this pip range was 73 pips. So this is information that is also valuable for you as a trader, and that is you can see how much pips usually the price goes during the day. If you take the average of these several 10 candles, you can see how much is the average. Is it 70 pips or 50 pips? So you can expect on average how much pips the EURUSD can move during the day. You can also here see the details, what is the pip range, what is the average daily range. If you click on it, you will have a table with several symbols, currency symbols that are located together and compared what is the average pip range during the week. And this is very helpful if you would like to know that. Now, the next one is very important. The topic, one of the most important things, is what is a lot size. A lot size represents how much one pip will be equal to. So, for example, if the price change, for example, from here currently, you can see I have a commission pretty large, but without the commission, this will be 0. So whenever the price change for 1 pip, that is 4th decimal point, it depends what is the lot size you have defined. In my case, I have defined a size 1. That means whenever the price change by 1 pip, I could make, here it is one standard lot, I could make $10. So this lot size, I will open a new order so I can understand what is the lot size and where it is located. This is the volume, which means a lot size. A lot size has defined several levels, and one is standard lot, 1 mini lot, 1 micro lot, and 1 nano lot. 1 micro lot is defined as a 0.01 inside here. So the smallest one that I can open on EURUSD is 0.01. The maximum one I can open is 8 standard lots, which means 8 multiplied with 1 standard lot. So how the price will change depends also on this lot size that I define. For example, if I define that the volume should be 1, whenever I click the buy market or sell by market, the new order will open, and whenever the price changes, you will see how the profit changes. For example, if there is no price change, I am in minus $7 because of this commission. But if the price change, it should change by $10. So we can see that I am in plus 1 pip. This I am in plus by 1 pip. That means $10. But if I add, just a minute, 73 minus 1, let's change this profit as a points. It will be much easier for us to understand this one. Now, if the EURUSD has changed by 1 pip, and that means the price needs to change on the 4th decimal point. If it changes from 7 to 6 or 8, this will be changed by 1 pip. In my case, the price has changed by 2 pipettes, which means 0.2 pips. If 1 pip is equal to $10, 0.2 will be equal to $2. So if I add $2 to minus 7, I should be on a 5 minus $5. So you can see this one, 2 pipettes added, it is $2, added to the minus 7 should be 5. In this case, you can see this one. If the price changes by 1 pipette, this will mean 0.1 of $10 is $1. And if I add $1 to the minus 7 commission, I should get a final profit minus 6. So if the price changed by 10 units, this will mean I would be in plus for $10, but when I add commission, this should be here minus 3. Sorry, should be plus 3. So the lot size defines how much each pip will be equal to. So if you would like to test the different amounts of pips and also different lot sizes, you can use a demo account to try and test to see how this works. But if you would like to see more details about the lot size, I have created here another article, and I have other videos to show you details about the lot size and what is the difference. Then you have here also another article that shows you details about what is one lot. The final topic that should be also learned as a beginner and as a basic is volatility in Forex. I have created another article where you can see more details, but here it is something that I would like to show you. A volatility is activity on the market, how many traders are trading or not trading. If the traders do not trade, that means, let's see, to give you a bigger example, if the traders do not trade, you will have a small candles, which means a pip range that goes from the high to the low. You can see not even one not even 1 pip, the price has changed during 30 minutes, which is the time frame. You can see M30, which means 30 minutes. So this candle 1 represents a 30 minutes time frame. So when the price open in 30 minutes, the price is jumping up and down, not even for a pip. Then the second candle and the third candle are almost the same. So this means there are no many traders on the market that trade this pair EURUSD. And what you can see, what is the current time? It is in the morning, 1:30, then it is 2 o'clock, 2:30 in the morning, where the traders are not so active. And this is on a European time, 2:30, which means also the market is not moving on a US and also other trading sessions. When the market wakes up, you can see immediately how the price changes. So you can see a very large candle, which means this is high volatility, high activity on the trading, which means there are many traders that are trading this pair, so the price changes a lot. Whenever the market comes down, you will see the candles are very low, very small one. You can see that here also. It is also the time in the morning. So when is the market active, when it is volatile? Most of the time it is during the news, where you have a large spike. For example, this one with a large wicks, then this one a very large candle. These are most of the time where the news are released on the market. But if you would like to see more details, click this volatility, and you will click this volatility link, where you will see more details and also a chart that shows you what are the most volatile pairs. So these are the details that you need to learn as a Forex trading basics. Learn them because they are very important. Most of them that are most important is what is the pip, what is the lot size, because they define how much money you will make on your trade. This is the lot size that defines and how much pips the price changes. When you calculate these two, when you multiply the number of pips with the value of 1 pip, which is a lot size, you will get information how much you can make, but also how much you can lose. So these are all the Forex basic terms that you should learn as a trader, and you need to learn and understand them completely, not on the surface but in deep, so you understand what you're doing, and also when you're opening the trade, what is very important. If you have any questions, feel free to leave a comment below. If you like this video, click the like button and subscribe. See you next time, and happy trading.